Ladies and gentlemen, we are standing at the precipice of a financial singularity, a mathematical inevitability that is no longer a distant theoretical warning from economists but a cold, hard reality codified in the latest government data released in February 2026. And today, we are going to dissect exactly how the United States has locked itself into a trajectory toward a $56 trillion national debt that threatens to dismantle the American superpower from the inside out. We are looking at a fiscal landscape where the Congressional Budget Office, the non-partisan scorekeeper of our nation's finances, has released a report that should frankly terrify every citizen, investor, and policymaker, projecting that federal debt held by the public is going to explode from roughly $31 trillion in 2025 to a staggering $56 trillion by 2036, a trajectory that pushes our debt-to-GDP ratio from essentially 100% today to a record-breaking 120%, effectively eclipsing the debt level we saw immediately after fighting World War II, except this time there is no war to win and no peace dividend to follow, only a structural rot that has been accelerated by the massive legislative overhaul known as the One Big Beautiful Bill Act, or OBBBA, signed into law on July 4, 2025. You have to understand the mechanics of this disaster because it is not just about spending more than we make anymore. It is about a fundamental shift in the physics of our economy where interest costs are beginning to consume the state itself, with the CBO projecting that net interest outlays, the money we pay just to service our debt, will more than double from $970 billion in 2025 to $2.1 trillion by 2036, meaning we will soon spend more on paying off bondholders than we do on national defense or Medicare, creating a doom loop where we borrow money just to pay the interest on the money we already borrowed. This situation has been exacerbated by the OBBBA, a piece of legislation that the Committee for a Responsible Federal Budget estimates will add $4.7 trillion to the deficit over the next decade through a combination of permanent tax cut extensions and new deductions, even as it slashes the social safety net by cutting Medicaid and SNAP benefits, effectively transferring wealth while hollowing out the fiscal floor of the nation. The narrative that we can simply grow our way out of this with a sugar high of short-term stimulus has been debunked by the data, which shows that while the economy might surge to 2.2% growth in 2026 due to this fiscal injection, it will inevitably slow down to 1.8% in the years following, as the crowding out effect of federal borrowing drives up interest rates and stifles private investment. We are seeing a complete deterioration of the nation's balance sheet, where federal outlays are projected to reach 24.4% of GDP by 2036, while revenues stagnate at 17.8%, leaving a structural deficit of nearly 7% of GDP that is simply unsustainable in the long run without triggering a currency crisis or a sovereign debt crisis. The CBO's director explicitly warned that this fiscal trajectory is not sustainable, pointing out that our deficits are staying elevated at nearly 6 to 7% of GDP even during periods of low unemployment, which is historically unprecedented because typically you only run deficits this high during a recession or a war, not during a period of relative peace and economic expansion. This structural deficit is being driven by the aging of the population and the rising costs of healthcare, with Social Security and Medicare outlays projected to rise significantly, yet the trust funds that support these programs are racing toward insolvency, with the Highway Trust Fund running dry by 2028 and the Social Security Old Age and Survivors Insurance Trust Fund hitting zero by 2032, a mere 6 years from now, which would legally mandate an automatic 28% cut in benefits for every retiree in America unless the law is changed. This is the crumbling path that budget watchdogs have warned us about, where the government loses its fiscal space, meaning its ability to respond to future emergencies like pandemics, wars, or financial crashes because its credit card is maxed out and the interest payments are eating the entire paycheck. The OBBBA attempted to offset some of its massive tax cuts with aggressive tariffs, which the administration claims will raise revenue, but the CBO analysis shows that while these tariffs might reduce the deficit on paper by $3 trillion, they also act as a massive tax on consumers, raising inflation and lowering GDP output by distorting trade flows and reducing the efficiency of the American economy. We are also seeing a major shift in the global perception of the US dollar, which has held the exorbitant privilege of being the world's reserve currency for decades, allowing us to borrow cheaply and run deficits that would bankrupt any other nation. But that privilege is eroding as we weaponize the dollar through sanctions and as our fiscal house burns down. We are seeing the rise of a multipolar world where countries like China, Russia, and the expanded BRICS alliance are actively pursuing de-dollarization strategies, hoarding gold, and setting up alternative payment systems like CAPs to bypass the U.S. financial system, a trend that is accelerated by the perception that the U.S. government is fiscally irresponsible and politically unstable. The International Monetary Fund has already flagged the U.S. as having one of the largest projected increases in public debt among advanced economies, warning that our persistent deficits exert upward pressure on global interest rates and could trigger financial instability worldwide. When we look at the specific provisions of the OBBBA, we see that it tries to solve a solvency crisis with gimmicks, such as the Trump accounts or baby bonds that expire in 2028, and changes to student loan repayment plans that actually increase costs for many borrowers, all while slashing Medicaid funding by 12% and imposing strict work requirements that are projected to kick over 10 million Americans off their health insurance, creating a public health crisis that will likely lower productivity and increase long-term costs. The bill also ramps up funding for immigration enforcement to unprecedented levels, turning ICE into the largest federal law enforcement agency with a budget exceeding $100 billion, a move that the CBO projects will actually harm the economy by reducing the labor supply and lowering GDP growth because we are cutting off the demographic inflow that has historically kept America young and productive compared to aging rivals like China and Europe. This reduction in the labor force, combined with the crowding out of private investment due to government borrowing, creates a stagflationary risk where we have high inflation from tariffs and deficits, but low growth from labor shortages and lack of investment. We must also talk about the interest rate environment, because for 20 years we lived in a fantasy world of near-zero rates that made debt seem free, but that era is over. The CBO projects that the 10-year Treasury rate will settle around 4.4%, which means the government is refinancing its massive $31 trillion pile of debt at much higher rates, causing that explosion in interest costs I mentioned earlier. This is the tipping point where the math simply stops working, where every dollar of tax revenue is increasingly consumed by mandatory spending and interest, leaving nothing for infrastructure, education, science, or the investments needed to compete with China in the 21st century. Speaking of China, their economic challenges are significant, but they are watching our fiscal suicide with interest, knowing that if the dollar loses its status as the global safe haven asset, the American empire's ability to project power and finance its military dramatically diminishes. The One Big Beautiful Bill was sold as a way to unleash prosperity, but the non-partisan analysis shows it is a mechanism for upward wealth transfer that exacerbates inequality, creating a reverse Robin Hood effect where the poorest lose their health care and food assistance to fund permanent tax cuts for corporations and the wealthy, all while blowing a hole in the deficit that our children and grandchildren will be forced to fill. The notion that we can fix this with efficiency, or AI, as suggested by figures like Elon Musk, is mathematically illiterate when you look at the scale of the problem. You cannot close a $2 trillion annual deficit by cutting waste when the drivers are interest, Social Security, Medicare, and defense, none of which the political class is willing to touch meaningfully. The reality is that the United States is sleepwalking into a sovereign debt crisis that will force a brutal austerity on the American people, characterized by higher inflation, which acts as a hidden tax on everyone, reduced public services, and a diminishing standard of living relative to the rest of the world. The bond markets are the ultimate vigilantes, and while they have given the U.S. a long leash because of the depth and liquidity of our financial markets, that leash is tightening as foreign holders of U.S. debt like Japan and China diversify away from the dollar. If we hit a point where the world no longer wants to buy our treasuries at low rates, we will face a choice between defaulting on our obligations, which would destroy the global financial system, or printing money to pay the debt, which would trigger hyperinflation and destroy the dollar. This is not fear-mongering. This is the arithmetic provided by the CBO, the CRFB, and every serious budget analyst who has looked at the numbers presented in the February 2026 outlook. The OBBBA has locked us into a path where debt hits 120% of GDP in a decade and 175% by the mid-century, a level that is essentially unrecoverable without a catastrophic reset of the economic order. We are seeing the warning signs now, with the bond yields rising, the trust funds drying up, and the geopolitical sharks circling, waiting for the moment when the American Leviathan can no longer afford its own weight. The tragic irony is that this was a choice. We chose to pass a tax cut we couldn't afford. We chose to ignore the entitlement crisis for decades, and we chose to engage in trade wars that impoverished our consumers. And now the bill is coming due in the form of a $56 trillion mountain of debt that casts a shadow over the entire future of the American experiment.